welcome to the Deep Dive. Today we are tackling SoFi Technologies, ticker SOFI. You probably know SoFi. They've been building this really ambitious vision, right? To be your single place for borrowing, saving, spending, investing, basically all things money.
Yeah, it's that unique mix of like a traditional bank but with a heavy tech layer.
Exactly. And after pouring huge amounts of money into building it all out, they've hit this big milestone. Consistent profitability. But you look at the market's reaction, it's definitely mixed.
Right, and that mix tells you there's a real debate happening. What is SoFi fundamentally? What's it going to become? And, what's it actually worth?
So our mission today, drawing only on this stack of research and analysis we have, and this is important, it's anchored specifically to early June 2025, mainly using their Q1 2025 earnings data.
Which came out April 29th.
Right, so using that time frame, we're going to deep dive into SoFi, looking at it through, let's say, a value investor's lens.
We'll pull out the key insights, the business itself, the management, the financials, the risks, the opportunities, everything the sources cover. The goal is to give you a fast track, a shortcut to getting really informed on SoFi, using only the material right here.
Exactly. And look, if this kind of breakdown is useful for you, please like and subscribe to the Stock Analytics AI YouTube channel. It really helps us out.
Yeah, and quick plug, if you become a member, it's Euro $4.99 a month. You can actually give us a ticker symbol, and we'll prioritize doing a deep dive analysis or an earnings review on that specific company for you.
It's a great way to directly influence what we cover.
Definitely. And make sure you stick around till the end. We're going to touch on one of those key external risks. The analysis pointed out something like the potential impact of U.S. tariffs and how that might ripple through SoFi's business, maybe in ways you wouldn't immediately think of.
Ooh, yeah. That's the kind of nuance you don't want to miss. So again, hit subscribe wherever you're listening. Okay, ready to jump in? Let's do it. All right, so first things first. With any company, you absolutely have to understand what it actually does. How does it make money? So let's unpack SoFi's business model. What are the core pieces?
Okay, so at its heart, SoFi runs on three main segments. And understanding how they interconnect is really key to that whole one-stop shop idea. First up is lending.
That's the original SoFi, right? Student loans.
Yeah, that's where they started. Personal loans, student loan refinancing, now home loans too. They make money here mainly from net interest income, the difference between what they pay for funds and what they earn on loans, plus fees, and sometimes they sell loans off their books. In Q1 2025, the source says this segment brought in about $412.3 million in adjusted revenue.
Okay, so the direct lending part. Got it. What's segment number 2?
That's the technology platform. This is more behind the scenes, their B2B business-to-business side. It's powered by companies they bought. Galileo and Technisys. Think of it like they provide the plumbing, the tech infrastructure.
The pipes?
Exactly, the pipes. For other companies, other fintechs maybe, or even banks, to offer financial services, things like payment processing, core banking functions. Revenue here comes from, platform access fees, transaction fees. This part did about $103.4 million in adjusted revenue in Q1. But maybe more impressive, the source says it powers something like 158.4 million accounts globally for its clients. It's got huge reach.
Huh, interesting. So they're building tools for others too, not just for themselves.
Okay.
And the third segment?
The third is financial services. This is basically everything else you see inside the SoFi app as a consumer. Your checking and savings accounts, the Invest platform, both for active trading and automated investing credit cards, insurance products they offer access to, credit monitoring. You get the idea.
Daily money management stuff.
Precisely. This is where they build that day-to-day relationship. Revenue here is more diverse net interest income from the deposits in those checking savings accounts, interchange fees when you use their card, brokerage fees, and so on. And this segment was pretty big, too, about $303.1 million in adjusted revenue in Q1.
So lending, tech platform, financial services. The source mentioned they're really pushing to grow those non-lending parts, right? The tech platform and financial services. Why the big strategic focus there?
Oh, it's absolutely crucial. The source notes that those two combined tech and financial services generated $406.5 million in Q1 25, and that was up a massive 66% year over year.
66%.
Yeah. And the why behind it is diversification. Lending, it can be very cyclical. It really depends on interest rates, the economy.
Credit cycle.
Exactly. So by growing these other revenue streams, which tend to be maybe a bit more stable or recurring, SoFi is trying to become less reliant on just the credit markets. It builds a more resilient business overall, potentially with better margins down the road. That 66% growth shows they're making real progress on that shift.
Got it. Makes total sense. Reduce reliance on the part most sensitive to economic swings. Okay, let's drill down on the products themselves. What are people actually using?
Well, in lending, even with higher rates, Q1 saw record originations, $7.2 billion total. That's across personal loans, student refi, private student loans, and home loans. Suggests pretty strong demand.
Okay.
Then in financial services, this is where you see that really rapid growth in adoption. The checking and savings accounts, they push the high APY, no account fees model. There's the Invest platform, the credit card, Protect for insurance access, Relay for credit monitoring. The source highlights just how fast this is moving. 13.8 million financial services products added in Q1. That's up 36% year over year.
36% growth in products. That's fast.
It is. And here's the kicker. That category, financial services, accounted for 90% of their total product growth in the quarter.
Wait, hold on. 90% of new products came from financial services, not lending.
That's what the source says. It's a huge signal, right? Tells you where the momentum is. People might come in for a loan, maybe, but they're really engaging with and adopting these other daily financial tools afterward.
That really speaks to the one-stop shop actually working or starting to work.
It definitely supports that narrative. They're pushing it all through this single mobile app, aiming for convenience, put everything in one place. Now, the source does add a little caution here, acknowledging the massive operational and technical complexity involved in making all these different things work together smoothly.
Yeah, I can imagine building one piece is hard, making them all play nice together.
Yeah.
Even harder. And speaking of growth, they've achieved some serious scale, haven't they?
They really have. Scale is critical. By Q1 25, over 10.9 million members. That's up 34% year over year. Total products hit 15.9 million, up 35% year over year. And don't forget that tech platform powering 158 million accounts globally. That's huge infrastructure reach.
But the real game changer, the thing that separates them from a lot of other fintechs, has got to be that bank charter, right?
Oh, absolutely. The source really emphasizes how important that national bank charter is, SoFi Bank NA, being regulated by the OCC, the Fed. It's not just about looking legitimate. It gives them direct access to low-cost, stable funding. Deposits.
Right.
They had $27.3 billion in deposits in Q1, and the source says over 90% of that came from members who use direct deposit. That is sticky, cheap money compared to what non-bank lenders have to pay. It's a massive structural advantage. The source also kind of hints at the potential value in all the data they're collecting across this whole ecosystem.
Data being the new oil, of course. They mentioned ARPU2, annualized revenue per product. Why track that?
ARPU, which was $88 in Q1 25, is basically a measure of monetization. Are they actually making more money from each product relationship over time? It's not just about signing people up. It's about deepening the relationship, getting them to use more, and generating revenue. Watching that ARPU trend tells you if the cross-selling is actually boosting the value of each customer.
Okay, let's try and wrap this section up. What's the core value proposition here? Why should someone choose SoFi?
Well, their stated proposition, according to the source, is being that member-centric, one-stop shop. Borrow, save, spend, invest, protect, do it all in one app. Their mission statement is to help people achieve financial independence. So the appeal is really convenience, potentially better rates because of that bank charter, and this comprehensive digital toolkit. Success really hinges on getting you to use more than one thing, the cross-selling.
And you said product growth is slightly outpacing member growth.
Yeah, 35% product growth versus 34% member growth. It's a small difference, but it's a positive sign that members are adopting more products on average. It was around 1.46 products per member in Q1, which, frankly, still leaves a lot of room to grow that number.
So convenience, integrated tools, competitive products, all digital.
Exactly. And the foundation enabling all that, theoretically, is that vertical integration owning the bank and the core tech stack like Galileo and Technisys. The source calls it a cornerstone. It gives them control, potentially better efficiency, maybe a smoother user experience because they're not relying on as many third parties.
Right, controlling more of the value chain. Makes sense. Okay, we've got a good handle on what SoFi is and how it operates. Let's pivot to the people in charge. Who's steering this ship? What's their background?
The leader is CEO Anthony Noto. He's been CEO since March 2018. And his background, as the source lays it out, is pretty interesting, quite diverse. He was COO and CFO over at Twitter. Before that, a big job at Goldman Sachs, co-head of their global tech, media, telecom, investment banking group, made partner there. And he was even CFO of the NFL for a stint.
Wow. Finance, tech operations, Major League Sports. That's quite a mix. Seems relevant for a fintech bank, though, right?
You'd think so, yeah.
Yeah.
That blend seems pretty well suited to the challenges SoFi faces.
What are some of the big strategic moves under his leadership? The source mentioned a table.
Yeah, Table 3 in the source hits the highlights. He took them public via SPAC back in June 2021. That deal valued them at about $8.65 billion then. He's driven those key acquisitions. Galileo in 2020 for payments tech, Technisys in 2022, that was a $1.1 billion deal for core banking tech, and Wyndham Capital Mortgage in 2023.
And the SoFi Stadium deal.
Yep, that naming rights deal in 2019. Crucially, he secured the national bank charter in 2022, and then, most recently, leading them to those 6 straight quarters of GAAP profitability, the record Q1 results, and raising the guidance for 2025.
Looking at that list, it doesn't feel like random moves.
Yeah.
It feels like steps in a plan.
That's definitely how the source frames it. Not just isolated events, but interconnected pieces of a deliberate strategy to build this integrated digital bank. It suggests Noto has a clear long-term vision and is executing on it, using both internal growth and these big strategic acquisitions.
Does the source give any feel for how they handle tough times, like market volatility or unexpected issues?
It doesn't go into specific crisis management examples, but the context implies resilience. I mean, navigating the interest rate hikes, the market pressures of the last couple of years, and still hitting sustained profitability for 6 quarters, that suggests a team that can execute when things get choppy. The source also kind of contrasts SoFi's record student loan originations in Q1, up 59% year over year, against the backdrop of the student loan payment pause ending in rising delinquencies nationally. Growing strongly in that environment might point to good risk management, maybe focusing on borrowers with better credit profiles. It also links their focus on profitability to navigating broader pressures, like those tariffs mentioned as a risk later on.
So getting results despite headwinds suggests they're capable. What about communication? How to be transparent with investors and the public?
Based on what's in the sources, yeah, their communication seems pretty robust. They use their website, social media X, LinkedIn. They do quarterly earnings calls. The source even calls them deep dives. Standard quiet periods before earnings. Noto himself does investor conferences, like that fireside chat in May 25. And the Q1 earnings release itself was apparently quite detailed: segment results, key metrics, guidance. Seems like a solid multi-channel effort.
Okay, let's sum up leadership. Based only on this source material, does it suggest management is honest, capable, and aligned with shareholders?
All right, based solely on this info. Honesty. Communications appear transparent, detailed. Nothing here suggests otherwise. Capability. Noto's background plus that track record, the IPO, the key acquisitions, the bank charter, and hitting sustained profitability strongly points to capable leadership executing a plan. Shareholder-oriented. Well, the drive for GAAP profit, raising guidance, focusing on growing tangible book value, those are generally seen as shareholder-friendly moves. Plus, the source highlights Noto's own significant stock ownership, 0.89%, worth around $140 million then, and mentions his consistent open market buys in 23 and 24. That's a big alignment of interests.
Get in the game.
Exactly. Now, the source does note they aren't doing buybacks or dividends currently. They're reinvesting capital for growth, which is pretty typical for a company still scaling up like this.
Got it. A clear picture from the sources on leadership. Okay, let's crunch the numbers. How does SoFi's financial health look according to this analysis?
All right, key metrics from Q1 25 and early June 25 market data. Market cap was around $15.1 billion. The trailing 12 months price to earnings ratio, PE, was 31.33.
31 times earnings. That jumps out again. Seems high for a company that only recently turned consistently profitable, doesn't it?
It really does, and that's the core insight, right? A PE like that, especially just after hitting profitability, tells you the market isn't just valuing last year's earnings, it's pricing in significant future earnings growth. Huge expectations.
So optimism is baked in. High expectations for growth and maybe margin expansion.
Exactly. Which also means it's vulnerable, right? If that growth doesn't quite meet those high expectations, the stock could react poorly. It demands strong execution.
Okay, high expectations.
Yeah.
How's the actual revenue growth been? Is it supporting that story?
Revenue growth has definitely been a strong point consistently. Q1 25 GAAP net revenue, $771.8 million, up 20% year over year. Adjusted net revenue was even stronger, $770.7 million, up 33% year over year.
Quick clarification. Adjusted usually means they're backing out some items, right?
Yeah, typically things like stock-based compensation or maybe one-off acquisition costs. Management presents it as a clearer view of core operations. Full year 2024 revenue was up 26%. and their guide for 2025 is for another 24% to 27% growth. The source specifically calls out, again, that strength in financial services and tech platform. Remember that combined 66% growth in Q1? That's driving a lot of it.
Okay, strong top-line growth is definitely there. What about profit margins? Are they getting better as they get bigger?
Yes, they are improving, though the source does mention the overall net margin might still be lower than some industry peers for now. Q1 25 JAB net income was $71.1 million. That works out to a net margin of about 9.2%. Adjusted EBITDA was $210.3 million, which is a pretty healthy 27% margin on that adjusted revenue figure.
And the different segments have different profitability levels.
Right. The source gives segment contribution margins. Lending was strong at 58%, financial services at 49%, and the tech platform at 30%. The thinking is, as those higher margin financial services and tech platform businesses become a bigger slice of the pie, the overall company net margin should theoretically continue to expand.
Okay, positive income, improving margins, promising signs. How's the balance sheet, specifically debt levels?
Balance sheet looks pretty solid based on this. Their debt-to-equity ratio was 0.47. The source notes that's actually below the norm for financials, suggesting they're not overly leveraged. And the huge advantage, again, is that deposit base from the bank charter. $27.3 billion in Q1, mostly from sticky direct deposit members. That's reliable, low-cost funding. Big strength.
That deposit base really seems like their anchor. Did the source mention free cash flow?
The snippets provided don't actually detail specific free cash flow numbers, which isn't totally surprising for a company like SoFi. They're investing heavily right now in tech, infrastructure, growth, acquisitions. So even with positive net income, those investments can eat up cash, meaning FCF might be low or variable for now. The focus seems to be reinvestment, not generating immediate free cash.
Makes sense for this stage. Okay, last check on valuation relative to assets. Price to book, price to tangible book.
Right. For banks, price-tangible book value PTBV is often seen as more relevant because it strips out intangible assets like goodwill from past deals. Using early June numbers and a $14.24 share price, the calculated PB was about 2.35 and the PTDV was 3.101.
3 times tangible book value. What does that tell us?
It reinforces that same story from the PE ratio. The market values SoFi at more than 3 times its hard, tangible assets. It reflects confidence in the value of the intangibles, the brand, the tech, the member relationships, and again, implies big expectations for future growth and profitability that will generate returns well above the current asset base. The source does note management is focused on growing tangible book value per share, which is good long-term focus.
Okay, so summarizing financial health from these sources. Profitable now, solid balance sheet.
Yeah, that's the picture. They've hit profitability, 6 quarters running gap positive, expecting more growth in 25. The balance sheet seems sound, growing equity, that strong deposit base providing stability, and manageable debt levels below industry norms. Financially, they seem to be on a solidifying path, but definitely valued on future potential.
All right, let's zoom out again. How is the wider market feeling about SoFi? Sentiment seems divided.
Definitely divided. No clear consensus yet. The source points to mixed analyst ratings around late May, early June 25. One snapshot showed about 55% buy ratings, 18% hold, but a pretty chunky 27% sell. Another look across 5 analysts had 1 bullish, 1 somewhat bullish, and 3 just indifferent.
So even after good results, analysts are still split.
Exactly. It tells you there's still a fundamental disagreement about valuation, about the sustainability of their model, maybe competitive threats. The jury's still out for many professionals.
And the stock price reflects that uncertainty, bouncing around a lot.
Totally. That 52-week range mentioned $6.01 to $18.42 is huge. That kind of volatility is classic for a stock where the market is still trying to figure out what it is. Is it a bank? Is it a tech company? Is it a new hybrid? That uncertainty fuels the swings.
What about specific price targets from analysts? Where do they see it going?
Well, the average 12-month targets in early June clustered around $14.40 to maybe $15.07. With the stock trading in the $13, $14 then, that suggests only modest upside based on the average view. But the key thing is the range of those targets. The source mentioned lows of $6 and highs up to $21.
Wow, $6 to $21? That's a massive disagreement.
Huge disagreement. It perfectly captures the analyst split. The source did note some average targets ticked up slightly after the strong Q1 report, which makes sense given the better fundamentals and guidance.
What recent news was really driving this sentiment?
Number one, absolutely, was that Q1 2025 earnings report on April 29th. Record revenue, solid growth, $71 million in GAAP net income, raising guidance. It's fundamentally positive news that likely encouraged the bulls.
Sure.
Other things mentioned were Noto speaking at that investor conference in May, and then some new analyst coverage starting like a hold from Truist, a market outperform from JMP, plus some target bumps from banks like Barclays and UBS, even if they kept neutral ratings.
So the company's delivering operationally, but the valuation concerns are keeping some analysts on the sidelines.
That seems to be the story the source paints. Execution looks good, numbers are improving, but for some, the price already reflects a lot of future good news, leading to caution or even bearish calls.
Let's peek at some other market signals. Short interest, options.
Yeah, interesting data points here. Early June 25, short interest was high, 146.4 million shares shorted. That's almost 13.5% of the float.
13.5% shorted. That's significant.
It is. It means a decent chunk of the market is actively betting the price will fall. Could be valuation worries, competition, macro fears. Who knows? The days to cover was 2.62 days. That's moderate. Suggests if the stock did pop, it would take shorts a couple of days to cover, so a squeeze is possible, but maybe not a super prolonged one.
Okay, sizable bearish camp. How does options activity stack up against that?
Here's where it gets a bit contradictory, maybe. The put-call open interest ratio was 0.69. That's below 1.
Meaning more calls than puts?
Exactly. Significantly more open call options bets the price goes up than put options bets the price goes down. Usually a ratio below 1 like that is seen as more bullish leaning from the options crowd, so it kind of contrasts with the high short interest in the stock itself. Could be real bullish bets, could be hedging by the shorts. Hard to say for sure, but it shows a complex positioning picture.
Interesting divergence there. Okay, let's shift to who owns SoFi. Does the ownership structure reveal anything useful?
Yeah, looking at the breakdown is insightful. Institutions own a big chunk, 47.5% as of early June, held by 834 different firms back in March. You see the usual big names like Vanguard with nearly 100 million shares, BlackRock with around 47 million. That's pretty standard. Add some credibility.
Did the source say if institutions were buying or selling recently?
It did note that in Q1 2025, looking just at active managers, not passive index ones, there was slight net selling. About 84 million shares sold versus 77 million bought. Something to keep an eye on, perhaps, though passive flows are different.
What about insiders, management directors? How much skin do they have in the game?
Insiders own a pretty hefty amount, too, 17.05%, which was about 188 million shares held by 45 insiders. And the source specifically calls out CEO Anthony Noto again. His stake is 0.89%, valued around $140 million back then. And it highlights his consistent open market purchases of SoFi stock in 2023 and 2024.
The CEO buying shares on the open market, that's usually a strong positive signal, isn't it? Confidence.
Generally, yes. It's seen as aligning interests directly with shareholders, putting your own money on the line. The source does mention some other insider sales occurred from other execs, a director entity, which could be for normal personal reasons, diversification, taxes, but you'd monitor those alongside the CEO's buying.
Does the ownership seem concentrated? Like a few big players calling the shots?
Doesn't look like it from this data. Institutional ownership is broad, spread across hundreds of firms. Vanguard's the biggest single one at around 9%. Insider ownership is significant overall, but spread among 45 people. Seems like management is accountable to a pretty wide shareholder base, which is generally good for governance.
And how does this connect to corporate governance practices mentioned?
The source points to some good basics. A board with decent average tenure, 4.8 years, overseeing management, average tenure 2.2 years. An independent non-executive chairman, that's a plus. Lots of independent directors. That's significant insider ownership aligning interests. Their communication practices we talked about earlier, it suggests standard good governance structures are in place, though a full deep dive would require looking at committee structures and things in the proxy statements.
Okay, good overview of ownership and governance. Now let's synthesize everything into risks and opportunities. The classic SWOT analysis. Based only on the source material, what are SoFi's key strengths?
All right, pulling straight from the sources. That integrated platform, the one-stop shop concept. The big benefits from the national bank charter, especially low-cost funding. Their vertically integrated tech stack owning the key technology. Gives control, efficiency, a strong brand, growing member base, experienced leadership, particularly Noto's background and track record, and importantly, that recent shift to profitability and continued growth momentum.
Okay, what about the internal challenges, the weaknesses identified?
Weaknesses noted or implied are The path to high, sustained profitability. They're profitable, yes, but margins might still lag some peers. The sheer complexity of running this integrated model, operational, technical challenges, needing constant innovation in a really fast-moving fintech space. Customer acquisition costs generally a challenge for fintechs, though no specific numbers were given here, and potential integration risks from those big acquisitions like Galileo and Technisys, making sure they're fully absorbed and working well.
Makes sense. Okay, turning outward now. What opportunities can they tap into?
The opportunities look significant. Major potential in cross-selling more products to their existing 10.9 million members. Remember that 1.46 products per member figure. Lots of room to grow that. Growing that tech platform, selling banking as a service or embedded finance tools to other companies, that's seen as a huge market. Expanding financial services for their new products, maybe more wealth management, insurance options. Leveraging all the data they gather from their ecosystem for better insights, products, risk assessment, maybe long-term international expansion, possibly using Technisys' footprint in Latin America as a starting point, and just continuing to take market share from slower traditional banks and credit unions.
Seems like plenty of avenues for growth if they execute well. Lastly, the external threats. What dangers are lurking out there?
The threats are pretty serious too. Intense competition. They face rivals in every single area: lending, banking, investing, tech platforms. Big one, macroeconomic headwinds, inflation, interest rates going up or down, recession risk. All that impacts consumers, credit quality, loan demand. Big one. Regulatory changes, new rules around lending, bank capital, data privacy could always hit them. Big one. Cybersecurity threats. Handling sensitive financial data makes them a constant target. Big one. Interest rate fluctuations messing with their lending margins or asset values. Big one. And, specifically called out in the source again, that potential impact from U.S. tariffs in 2025.
Right, the tariffs. Let's just clearly restate what the source says about that risk, keeping it neutral as reported.
Okay. The source identifies potential 2025 U.S. tariffs as a threat primarily because they could lead to higher prices for consumers. That could squeeze discretionary spending, put more strain on household finances, and potentially lead to higher credit delinquencies across the economy, which impacts lenders like SoFi. It also adds to general recessionary risks, market volatility, and could even hurt their B2B clients on the tech platform if those businesses suffer. It's presented purely as an external economic risk factor identified in the analysis, not a political comment.
Understood. Retorting the risk as identified. That SWOT really lays out the battlefield clearly.
It does. It shows what they have going for them internally, where they need to improve, what external trends they can ride, and what dangers they need to navigate.
All right, we've hit SoFi from all sides. Business, management, financials, market view, ownership, SWOT. Let's try to bring it all home in a conclusion and outlook.
Okay, so SoFi's clearly built something unique, this blend of a bank, a tech firm, and a broad consumer finance ecosystem. They've made real progress, especially hitting sustained GAAP profitability, driving strong growth, and integrating those acquisitions to build out their vision. That vertical integration and the bank charter seem like genuine advantages.
But as we saw, significant hurdles remain.
Absolutely. Competition is fierce, the model is complex to run well, constant innovation is needed, and they're definitely sensitive to the macroeconomy.
So let's circle back to that specific external factor we teased.
Yeah.
The potential tariff impact.
Yeah.
How did that fit into the big picture conclusion?
It serves as a really concrete example of those macroeconomic threats, right? The source analysis points out how something like tariffs could ripple through. Maybe higher consumer prices, less spending, more financial stress, higher credit losses for SoFi, plus potential recession risk, market jitters, even affecting their B2B tech clients. It just underscores that even an innovative digital player like SoFi isn't immune to big external economic shifts. It's a risk factor highlighted in the source that investors need to consider.
That puts in context well an external uncertainty noted in the analysis. So looking forward, what should someone interested in SoFi really keep their eyes on?
Based on this analysis, I'd say watch these things. Can they sustain and, more importantly, expand profitability and net margins? Can they keep driving strong growth in financial services and the tech platform and actually monetize it better? Push that products per member number up, land more big B2B clients? How well do they manage credit risk if the economy does slow down? Can they keep innovating and maintain a great user experience in that complex app? And critically, how does that valuation, that PE over 30, PTBV over 3 hold up compared to their actual results? They need to keep delivering to justify those multiples.
That's a clear checklist of key performance indicators.
Yeah, future success really rides on navigating the internal complexity and those external pressures while just continuing to execute on the integrated strategy.
And maybe a final thought for you, the listener, to chew on based on all this, SoFi is trying to be many things at once: bank, tech provider, financial supermarket. Given how hard that is and the intense competition, can they really weave it all together effectively? Can they leverage their unique data position to build something that's genuinely more efficient, more defensible, and more resilient over the long haul than both the old-school banks and the focused fintech players?
That's the multi-billion-dollar question, isn't it?
We really hope this deep dive into SoFi Technologies, based strictly on the research provided, has been valuable and given you a much clearer picture.
And one last time, if you did find this helpful, please hit like and subscribe over on the Stock Analytics AI YouTube channel. And remember, members, Euro 4.99 month, can request tickers for future deep dives.
Before we sign off, we need to read the important disclaimer section, verbatim from the source material.
Not financial advice. This report is for informational and educational purposes only and should not be construed as financial, investment, legal, or tax advice. The information provided herein is not a recommendation to buy or sell any security.
AI-generated content. This report has been generated with the assistance of artificial intelligence. While efforts have been made to ensure accuracy based on the provided source materials, the information has not been independently verified by a human financial professional for accuracy or completeness.
Do your own research. DYRR. Investing in securities involves risks, including the possible loss of principal. Readers should conduct their own thorough research and consult with a qualified financial advisor before making any investment decisions. Past performance is not indicative of future results. The authors and publishers of this report are not responsible for any investment decisions made based on the content of this report.
Information source limitation. The analysis and conclusions in this report are based solely on the research snippets provided. No external research or information beyond these snippets has been incorporated.
Forward-looking statements. This report may contain forward-looking statements that involve risks and uncertainties. Actual results may differ materially from those expressed or implied in such statements.
Thank you so much for joining us for this deep dive. We hope you feel better informed about SoFi.
And be sure to tune in next time for another deep dive into complex information.